With the way that things are going with housing, we could be in a nobody's market right now. According to Zillow's chief economist, the housing market is frozen up. Here, check this out.
All right, for more on surging mortgage rates and the housing market, let's bring in Skylar Olson, chief economist at Zillow. Skylar, great to have you with us.
Yeah, thanks for having me.
What finally gives here? I mean, supply-demand dynamics keep housing prices high. People can't afford to buy. I mean, at some point, something breaks, right? What is that?
Yeah, I mean, I think as mortgage rates have continued to go up, as opposed to trending down as maybe 6 months ago we were talking about, we were at least hoping for, we've continued to see new listings pull back. So you're looking at around, 0.25% down from what was normal in terms of the homes that are dropping into the market. So Diana is totally right there in terms of it's a supply and demand imbalance. So I agree as well. When we're thinking like what has to give, the owner has to have an incentive to sell. If I have that low rate, it's not a financial opportunity from the mortgage market that's going to incent me to move, right? It's a life fundamental. So it's either the time happening of getting divorced and having kids, or it's job loss. And I think that's one of the reasons why right now we're it's kind of confusedly optimistic, which makes mortgage rates go up because we don't need those safe assets, and they're related, the 10-year. But at that same token, that's going to keep the activity low in housing markets.
Seriously, too many people have come up to me and said that their biggest financial mistake was not investing in a house in 2008 and instead learning multiplication in elementary school. Funny stuff, huh? But honestly, this brings up the question for today's video. Who can actually buy a house now? I mean, if houses are barely affordable, then who's buying them? According to the latest Redfin data, home buyers must earn $115,000 per year to afford the typical U.S. home. That's about $40,000 more than the typical American household earns. So yeah, it's harder than ever for Americans to afford a home. The exact number? A home buyer must earn $114,627 to afford the median-priced U.S. home, up 15% from a year ago and up more than 50% since the start of the pandemic. That's the highest annual income necessary to afford a home on record. For some people, it's not even a matter of affording a house. They can barely afford to keep a positive bank balance. I know people who are paycheck to paycheck on a full-time 50-hour-per-week job that pays $28 an hour. This is literally madness. Housing costs are through the roof, and it's basically a 1-2 punch thanks to crazy high mortgage rates and soaring home prices. I mean, in August, the average rate for a 30-year fixed-rate mortgage was a whopping 7.07%, and they've even gone higher since then, hitting a jaw-dropping 7.57% during the week of October 12th. That's the highest that they've been in record in over 20 years. Could we be seeing 8% mortgage rates before the end of the year? Now, that would be scary. So you would think that with these insane mortgage rates, people would be less eager to buy homes, right? Well, it has cooled things down a bit, but here's the kicker. There's not enough homes to go around. So because of this low inventory, home prices are on the rise. In fact, the average U.S. home was selling for about $420,000 in August, which is a 3% bump from the previous year. We're just about $12,000 shy of the all-time high set in mid-2022. Now, let's talk about what the typical U.S. home buyer trying to buy a home is facing right now. Their monthly mortgage payment is sitting at an all-time high of $2,866 a month. That's a sizable 20% increase from the $2,395 just a year earlier. And mind you, back in the early pandemic days when mortgage rates were super low and home prices hadn't yet gone off the charts, the typical monthly payment then was $1,581 in August of 2020. So yeah, huge difference affordability wise. To afford a typical home back then, you would have needed to make around $75,000 a year. Now, if we fast forward to today and the typical American household is earning about $40,000 less than what you need to buy a median price home. In 2022, the median household income was roughly $75,000, but hourly wages haven't kept up. In 2023, they've only gone up by 5%. And that's just not enough to keep pace with the skyrocketing cost of home ownership. If corporations, and especially foreign corporations, were barred from buying single-family homes, then this probably would be a whole different story. But we can talk about that in another video. Speaking of, don't forget to subscribe to the channel and hit that notification bell. I really appreciate you guys watching our videos, and thank you for always lighting up the like button for us. You guys are the best, seriously. In an ideal world for home buyers, when mortgage rates go up, it would naturally lead to a drop in demand and home prices. But reality doesn't always play by the rules here. Right now, even though there's a slight uptick in new property listings, we're still dealing with painfully low inventory levels. Why? Well, many homeowners are hanging on tight to their low mortgage rates, and that's propping up the prices. So if you're dead set on buying a home, especially if you're a first-time home buyer, it might be time to get a little bit creative. Think about condos, maybe townhouses. They tend to be a little bit more budget-friendly compared to single-family homes. Or consider looking at more affordable parts of the country or suburbs where you get a little bit more bang for your buck. Now, when we talk about affordability, it's not as much of a headache for all cash buyers and move-up buyers. The brunt of this housing market madness hits first-time home buyers the hardest. People who can afford to, as they say, splash the cash, they're not really sweating high mortgage rates, and chances are they're making enough money to afford a home anyway. Now, for those who are selling their current home to buy another home, they're in a somewhat better spot than first-timers. That's because they've likely built up some equity in their current place, which takes a bit of the sting out of those soaring monthly payments. So here's the catch though. Those who bought at the height of the pandemic era market with a ultra low mortgage rate and need to sell now, not only are they giving up low interest rates, but they may have actually lost money on their home. So ouch. But if nobody can afford to buy a house, then how do they keep getting more expensive? Here's the thing, guys. You don't have to wait until houses become super affordable to buy one. I know that might sound a little bit strange, but there's a whole industry out there that's making this a reality. You see, you're not saving up for the entire house. You're saving for a down payment. Now, sure, wages haven't exactly kept pace with the rising house prices, but here's the trick. A down payment, typically around 20%, grows at a much slower rate in absolute terms. So people are still finding a way into the housing market. The average American brings home around $59,428 before taxes. After taxes and FICA, that leaves you with about $49,000. Now, let's just say that this average Joe or Jane saves a whopping 70% of their take-home pay. And yes, it is possible because I've actually done it. After 3 years of socking away this cash, they're still pretty much in the same place because guess what? The price of the average house has been rising just as fast as their savings. It's like a race where they're both sprinting at the same speed. But here's where it gets interesting. Most people are only saving for a down payment, right? So that 70% savings goal can actually shrink down to 14 or even 7% in a dual income household where both partners are pulling in the average salary. Now, 14% of your take-home pay sounds more doable compared to a whopping 70%. But this is just what you need to save to keep up with those rising home prices. It doesn't actually bring you any closer to your goal of owning a home. Lenders and banks know that this is still a pretty big commitment for most families, especially when they have to cover expenses like food, rent, and other essentials that keep getting more and more expenses while wages stay put. So instead, they've moved the goalposts. According to a report by the National Association of Realtors, the average down payment for a first-time homebuyer is a mere 7%. And for those who have been around the block and they've had time to build up some equity from their previous home, it's just 17%. So if you only need to put down a small deposit, house prices can keep on climbing and it won't become mission impossible to buy a house. Let's say you only have to save up for a 7% down payment. Well, with a 10% savings rate over 3 years from an average salary, you could get yourself into an average price house. Sure, it might require a bit more discipline than what the typical American can manage, but it's not out of reach with some dedication. Now, to make things interesting, Zillow recently announced a new game plan, a new loan product where you only need a 1% down payment for people who really can't save up the money. What does this mean? Well, you put down 1% and Zillow pitches in the extra 2% at the closing. It's a grant, so you don't have to pay it back. So even though house prices are outpacing your income, the entry ticket is getting smaller just as fast. So here's the catch. Even if you can swing the down payment, you've still got to handle those regular repayments. And if you can't cough up the full 20%, then you're in for a real challenge to keep up with the house payments. You'll really need all the help you can get in this housing market. Hopes that the Federal Reserve would somehow make life easier for first-time home buyers by making it harder for them to borrow money have run into reality. Home prices are still rising even as real estate transactions are decreasing. Over the past year, the Federal Reserve started cranking up interest rates almost every single month. They did this with a plan in mind: put the brakes on inflation and bring down prices, especially in the housing market. The logic is that when borrowing money becomes more expensive, fewer folks jump into the real estate game. And the Federal Reserve's hope was that if fewer people were out there buying property, it would lead to a reduced demand and in turn bring down those sky-high real estate prices. But here's the twist, guys. Even though real estate sales are indeed going down, prices are kind of stubbornly hanging on to their sky-high levels. Some analysts, including Goldman Sachs, predict that they're going to keep climbing. This may all just be a lag between home sales stalling and home prices eventually dropping, though. But this definitely can't go on like this in the housing market. As they said in the National Association of Realtors, the Federal Reserve simply cannot keep raising interest rates in light of softening inflation and weakening job gains. There are a few reasons home prices are not dropping and may not in the near future. One big reason is that folks who took out loans years ago when interest rates were super low don't really have a good reason to sell their homes and make a move. I mean, sure, they might make a tidy profit by selling, but they're diving into much higher interest rates if they try to buy a new place. This low motivation to sell is keeping the overall supply of homes on the market pretty tight. And even though we're seeing more houses being built than we've seen in decades, the inventory is still hovering around 700,000 homes. This according to the St. Louis Fed. That's double the record low we hit back in January of 2022, but it's still way below the 1.4 million homes that were up for grabs in 2016. And here's the kicker. Most of the new homes, whether they're single-family houses or apartments, aren't exactly what you'd call affordable. It's the result of years of the federal government not investing enough, high borrowing costs, and supply chain hiccups disruptions that have raised the cost of materials. Just to put it in perspective, the average home sale price, it was sitting pretty close to $400,000 last month, according to the St. Louis Fed. And for all you first-time home buyers out there, here's the bottom line. Do not hold your breath for the Federal Reserve to come into the rescue anytime soon. We definitely need to pick this up again in another video. Make sure you do not miss the next one. I'll see you guys there.